Breaking news for everyone collecting Social Security, SSI, or SSDI. The IRS just rolled out major tax changes that started today, and if you're a senior or someone living on a fixed income, you need to know about this right now. These changes could affect how much money you keep in your pocket this year, and if you're not prepared, you could be caught off guard when tax season arrives. Stay with me for the next few minutes, because what I'm about to share could save you from confusion, penalties, and unexpected tax bills in 2026. Welcome back to the channel. If you're new here, this is where we break down Social Security updates, SSI and SSDI news, and financial changes that directly impact seniors and people living on benefits. My job is simple: to make sure you're never blindsided by government changes. I'm here to protect your income, keep you informed, and help you plan ahead so you can live with peace of mind. Today, we're talking about the IRS tax changes that just went into effect for 2026. And yes, some of these changes will affect Social Security recipients, retirees, and people on fixed incomes. Before we dive in, do me a favor. Hit that subscribe button and turn on notifications. This channel is your early warning system. When the government makes changes, you'll know about it before it impacts your wallet. All right, let's get into it. What just changed with the IRS? So here's what's happening. Starting today, the IRS has implemented several tax changes for the 2026 tax year. These aren't small tweaks. These are adjustments that could change how much you owe, how much you get back, or whether you even need to file taxes at all. Let me break this down into the parts that matter most to you. Change. Number 1. New tax brackets for 2026. Every year, the IRS adjusts tax brackets to account for inflation. For 2026, those brackets have shifted again. Now, if you're living solely on Social Security, this might not directly affect you, because Social Security income is often not taxable, especially if it's your only source of income. But here's where it gets important. If you have any other income, maybe a part-time job, pension, investment income, or withdrawals from a retirement account, these new tax brackets will determine how much of your Social Security becomes taxable. Let me explain how this works, because it confuses a lot of people. Social Security benefits can become taxable if your combined income exceeds certain thresholds. Your combined income is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. Here are the thresholds. If you're filing as an individual and your combined income is between $25,000 and $34,000, up to 50% of your Social Security benefits may be taxable. If your combined income is above $34,000, up to 85% of your benefits could be taxable. For married couples filing jointly, if your combined income is between $32,000 and $44,000, up to 50% of your benefits may be taxable. Above $44,000, up to 85% could be taxable. Now, with the new 2026 tax brackets, even a small increase in other income could push you into a higher tax rate on that taxable portion. That means you could owe more than you expected. Real-world example, let's say you're a widow named Mary. You collect $1,800 a month in Social Security. That's $21,600 a year. You also withdraw $15,000 from your IRA to cover extra expenses. Your combined income would be about $26,300. That pushes you into the range where 50% of your Social Security becomes taxable. With the new tax brackets, the rate you pay on that taxable income might be slightly different than last year, and that could mean a bigger tax bill or a smaller refund. Change number 2, standard deduction increases. Here's some good news. The IRS has increased the standard deduction for 2026. For single filers and married individuals filing separately, the standard deduction is now $15,000. For married couples filing jointly, it's $30,000. And if you're filing as head of household, it's $22,500. This is important because the standard deduction reduces your taxable income. The higher it is, the less income you're taxed on. For many Social Security recipients, this increased deduction means you may owe even less in taxes, or you might not owe anything at all. Example, let's say you're a retired couple named John and Linda. You receive $36,000 a year in Social Security and $10,000 from a small pension. With the new $30,000 standard deduction, a large portion of your income is shielded from taxes. You might owe very little or nothing at all, depending on your total taxable income. But here's the key. You still need to understand your situation. Just because the deduction went up doesn't mean you're automatically safe. You need to calculate your combined income and see where you stand. Change number 3, retirement contribution limits. If you're still working, even part-time, or if you have a spouse who's working, pay attention to this. The IRS has raised the contribution limits for retirement accounts in 2026. For 401k plans, 403b plans, and most 457 plans, you can now contribute up to $23,500 per year. If you're 50 or older, you can add an extra $7,500 as a catch-up contribution, bringing your total to $31,000. For IRAs, the contribution limit is now $7,000, with a $1,000 catch-up contribution if you're 50 or older, so up to $8,000 total. Why does this matter to Social Security recipients? Because if you or your spouse are still earning income, contributing to a retirement account can lower your taxable income now, which could help you avoid triggering taxes on your Social Security benefits. Example, let's say you're 62, you're collecting early Social Security, and you're working part-time earning $20,000 a year. If you contribute $7,000 to a traditional IRA, that reduces your taxable income to $13,000, which could keep your combined income low enough that your Social Security stays tax-free. This is a strategy worth exploring with a tax professional. Change number 4, Earned Income Tax Credit. EITC adjustments. The Earned Income Tax Credit has also been adjusted for inflation in 2026. Now, this credit is primarily for low to moderate income workers. If you're retired and not working, this won't apply to you. But if you're still working part-time, or if you have adult children or relatives who are working and supporting you, they might qualify for a larger EITC this year. The maximum credit for 2026 for a worker with 3 or more qualifying children is over $8,000. Even workers without children can get a smaller credit. If someone in your household is working and earning a modest income, they should check if they qualify. It's free money that reduces what you owe, or increases your refund. Change number 5, changes to tax filing thresholds. This is a big one, especially for seniors. The IRS has updated the income thresholds that determine whether you're required to file a tax return. For 2026, if you're single and under 65, you must file if your gross income is $15,000 or more. If you're 65 or older, that threshold goes up to $16,250. For married couples filing jointly, if both of you are under 65, the threshold is $30,000. If one of you is 65 or older, it's $31,850. If both are 65 or older, it's $33,700. Here's what this means for you. If your only income is Social Security and it's below these thresholds, you probably don't need to file a tax return at all. But, and this is important, even if you're not required to file, you should file if you had federal income tax withheld from any source and want it refunded. You qualify for refundable tax credits like the EITC or additional child tax credit. You want to contribute to a health savings account or claim certain deductions. Example, let's say you're a single senior named Robert. You get $18,000 a year in Social Security and nothing else. You're over 65, so your filing threshold is $16,850. Your Social Security alone doesn't require you to file. But let's say you had a part-time job earlier in the year and $200 was withheld for federal taxes. If you don't file, you don't get that $200 back. So even though you're not required to file, it's in your best interest to do so. Change number 6. Medicare premium adjustments and IRMAA. This one's a little different, but it ties into taxes. So stay with me. If you're on Medicare, you know that higher income beneficiaries pay more for Part B and Part D. That extra charge is called IRMAA, the income-related monthly adjustment amount. The IRS uses your tax return from 2 years ago to determine your IRMAA. So in 2026, they're looking at your 2024 tax return. If your income was higher in 2024, maybe you sold a house, took a large IRA distribution, or had a one-time bonus, you could be paying higher Medicare premiums this year. Here's the issue. A lot of seniors don't realize this until they see their Social Security check and notice it's smaller because the Medicare premium went up. The good news? You can appeal your IRMAA if you've had a life-changing event, like retirement, loss of a spouse, or loss of income. You file Form SSA 44 with Social Security, and they may adjust your premium. But you need to be proactive. If you think your 2024 income was unusually high and it's affecting your 2026 Medicare costs, don't wait. File that appeal. Why are these changes happening? You might be wondering, why does the IRS keep changing things every year? The answer is inflation. The tax code is designed to adjust for inflation so that you're not unfairly pushed into higher tax brackets just because the cost of living went up. It's actually a protection, but it also means the rules change constantly, and if you're not paying attention, you can get caught off guard. That's why channels like this exist. That's why you need to stay informed. All right, let's talk about what you need to do to stay ahead of these changes. Understand your income sources. Sit down and list out every source of income you have. Social Security, pensions, IRA withdrawals, part-time work, investment income, everything. Add it all up. Then calculate your combined income using the formula I mentioned earlier. If you're close to those taxability thresholds, be careful. Even a small amount of extra income could trigger taxes on your Social Security. Check your withholding. If you're still working, make sure your employer is withholding the right amount of taxes from your paycheck. If you're taking distributions from a retirement account, you can choose to have taxes withheld. A lot of retirees don't do this, and then they get hit with a big tax bill in April. You can update your withholding anytime by filling out a new W-4 form with your employer or by contacting your IRA or pension administrator. Consider quarterly estimated taxes. If you have income that isn't subject to withholding, like freelance work, rental income, or investment gains, you might need to pay quarterly estimated taxes. The IRS expects you to pay taxes throughout the year, not just in April. If you underpay, you could face penalties. Talk to a tax professional if you're not sure whether this applies to you. Keep good records, save all your tax documents. Social Security statements, Form SSA 1099, 1099s from banks or brokers, receipts for deductible expenses, keep it all organized. If you're audited or if there's a question about your return, you'll need proof. Don't assume you don't need to file. Even if your income is below the filing threshold, filing a return might benefit you. You could get money back, qualify for credits, or avoid issues down the road. When in doubt, file. Get help if you need it. Tax law is complicated. If you're confused, scared, or unsure, talk to a tax professional. Many offer free or low-cost services for seniors. The IRS also has a volunteer income tax assistance (VITA) program that provides free help to people who make $64,000 or less. You don't have to figure this out alone. Listen, I know taxes aren't fun. I know this stuff can feel overwhelming, especially when you're living on a fixed income and every dollar counts. But here's the truth. Knowledge is power. When you understand what's changing, you can plan, you can prepare, you can protect your money. That's what this channel is all about. I don't want you to be surprised. I don't want you to lose money because you didn't know about a rule change or a deadline. I want you to feel confident and in control. So if this video helped you, if you learned something new, or if it gave you peace of mind, do me a favor. Turn on the notification bell so you never miss an update. Because the government is going to keep making changes. Social Security, Medicare, taxes, SSI, SSDI, the rules shift all the time. And when they do, I'll be here to break it down for you in plain English, with no confusion, no jargon, just the truth. You deserve to know what's happening with your money. You deserve to be informed. And you deserve a channel that actually cares about protecting your benefits. So subscribe. Join this community. Let's stay ahead of these changes together. And if you found this helpful, share it with a friend, a family member, or someone else who's on Social Security or living on a fixed income. They need to know this too. All right, let's wrap this up. Here's what you need to remember. The IRS has rolled out new tax changes for 2026. Tax brackets shifted. The standard deduction went up. Retirement contribution limits increased. And the thresholds for who needs to file have changed too. If you're living on Social Security alone, you're probably in good shape. But if you have any other income, you need to pay attention. Calculate your combined income. Understand the thresholds. Check your withholding. And don't be afraid to ask for help. These changes aren't designed to hurt you. They're adjustments for inflation. But that doesn't mean they won't affect you. You need to stay informed. The good news? You're here. You're watching this. You're already ahead of most people. So take a deep breath. You've got this. And remember, this channel has your back. I'll see you in the next video. Stay informed, stay protected, and take care of yourself.